Hello, everybody. We're on time today, and the technology appears to be working. So kudos to myself for finally getting this ironed out. We're gonna bring on my buddy Imran here. How you doing?
Hey man, how are you?
Good. So we botched the last two. Well, last time it was AWS went out at the moment that we were going live. So these things happen. But we made the December options expiration, which is a big one. There's a lot of gamma expiring. There's a lot of put positions expiring. We got the VIX expiration tomorrow. We got the FOMC tomorrow. So we're going to chat a little bit about that, and we'll look at some single stocks as well. So if y'all have any questions, feel free to post those up. We'll take some questions towards the end. Any hard questions, I will send over to Imran. And you guys got some softballs. Pass them on my way. So, how are you doing, Imran?
Yeah, I'm good, man. I'm good. Just had my macro call earlier today. Very much the focus has been on the Fed this week, right? So we've got so many central banks basically having their meetings this week, but all eyes on the Fed tomorrow, really. That's really the main. Yeah.
So you run, obviously your macro insights course. So you have some macro insights, which I think probably includes the Fed and interest rates and things like that. I steer clear of that realm because I don't really know. So what's kind of the view on the Fed tomorrow? What's sort of your 2 cents here?
So look, I think it's a case of a couple of weeks ago, obviously with Thanksgiving, we had that big Omicron scare, right? And the market suddenly thought, oh my God, is growth going to roll over again? Are we going to get a load of lockdowns? People are banning travel, and it really shocked the market. The market was positioned more for a year-end Santa rally, and then you had a bout of de-risking, and then we just squeezed straight back up again, right? If VIX overshot in both directions. Basically, it overshot to the upside, and then it came back down, and we found ourselves suddenly back above 4,700. But the thing the market really needs to focus on is, okay, fine, Omicron's gone, and it doesn't look like the death rates or anything like that we would maybe we had feared, but the hawkish pivot of the Fed. Normally, when you get these sort of fears and the market sells off a couple hundred points and Powell speaks, we're so used to Powell kind of reassuring us that everything's going to be okay. The Fed is monitoring the situation, blah, blah, blah. This time around, it was like, nah, we're dropping the word transitory and inflation is a problem and we're going to sort it out. So that hawkish pivot from Powell is really the thing the market now is figuring out and trying to rationalize and understand. And that's why some of the weakness over the last couple of days is the market had overshot a bit to the upside, and now it's like, oh, hang on a minute, we're going to find out just how hawkish the Fed is. And you've had a couple of macro guys who are quite well respected come out and say that they are massively behind the curve here, and they're going to have to come out and actually surprise us to the hawkish side to get back some credibility that yes, they completely dropped the ball on inflation. They underestimated it. It's not transitory. There's a bunch of reasons why, and they need to get on top of it, basically. And the question is, by waiting so long, have they got themselves into a place where they have to tighten too quickly to rein in inflation expectations and get back in the driving seat, as it were?
Yeah.
And if they do that, then do they basically crash the economy at the same time? So that's the concerns, and we're starting to see cracks under the surface in some of the rate sensitive sectors, like this super hyper growth tech type names.
So you and I were talking about ARK, right? ARK is kind of the poster child of the manifestation of that easy money, no revenue kind of tech space, and that stock's been getting creamed. It's still up, as you can see, 100% from basically May. But so I'm going to ask probably kind of an ignorant question here. I know most people are here for options, but if you look at like the 10-year and some things like that, there's really not much movement there at the moment. So you have the rate sensitive stocks are moving, but from the different things I look at in credit markets, it doesn't seem like spreads are really widening out, and even some of these bond ETFs, LQD, junk, those kinds of things, there's not really much movement there, right? So if you're expecting like a real catastrophe in the rate market, a real catastrophe in the rate market, those don't seem to be reflected in some of these.
Yeah, that's because it hasn't happened yet, right? Because they're flagging that they're tapering, but until the tapering actually takes place, these markets are still supported, right? So the credit market is a function of who's out there buying the bonds, right? So if the Fed are in there buying, however many billion worth of these securities, those prices are supported. It's only when they withdraw that and they stop buying and they start raising rates that this stuff is vulnerable, right? So there's a nice chart that I showed on my to my guys today, which is like the HYG, and you've got the Goldman's financial conditions index and the HYG kind of on the same chart, and every time financial conditions tighten, HYG sells off. And at the minute, financial conditions are very loose still, right? We think they're going to get tighter. We're expecting them to tighten, but this is an expectation. So the retail, like the meme stocks are getting crushed on that expectation, and confidence is coming out of crypto and things like that. But until we actually see the tapering and we see the withdrawal of that liquidity, then we'll see credit markets sell off, right? And that's what I think is the reason.
Yeah, so the equity market's kind of front running it or making some shifts ahead of some perceived moves, maybe in the credit market kind of wants to see what actually happens.
Yeah, and the equity market under the hood is showing some signs of stress, but like the broad indices, they've gone nowhere still, right? So that's the thing. Like,
Yeah, I
S&P
think.
at 400.
Yeah, I mean, we were looking at IWM earlier, and we posted a chart of this. I think in the note this morning that IWM's getting just crushed over the last 5 days. I think it's down 2.5%, 3% maybe with today's move. S&P's kind of flat over the last 5 days, and and Nasdaq is down. The Qs are down, but not as much as IWM. So there's tax loss harvesting maybe, and some other different kind of year-end flows. Maybe guys trying to protect their performance and things like that. But so we're going to have the FOMC here. Obviously, tomorrow we have the VIX expiration in the morning. Now, do you think the VIX expiration, in your opinion, is going to have any kind of effect on?
Well, VIX expires next week, right? I think 21st. Is that right?
Yeah, I'll double check that. I'm sorry, I made that.
Yeah, I think VIX expires the Wednesday before, but actually this time it's after. So kind of really depends what happens on FOMC and what happens into expiry this week. Whether there's anything to really say on the VIX. Going into Christmas week, for choice, if we get a little bit of a wobble this week, which it feels like we're in the middle of, and I think the Fed's going to be relatively hawkish, so I don't see us ripping back into expiry on Friday, but it might be a case of we see a bit of a crescendo on vol, and vol spikes into the end of this week, and then maybe VIX is a short play basically into VIX expiry for next week. So maybe something like that might work.
Yeah, and so it is next week. It is the 22nd, the VIX expiration, and the dynamic really is so interesting here in that we've kind of talked about this ad nauseum, but the Fed has maybe he'll however the market reacts to whatever Powell has to say, right? Who knows? But there's so much energy built up here in the fact that the VIX is fairly elevated. The S&P's term structure is pretty flat, right? It's not quite backwardated. Maybe it was for a brief second earlier, but that curve could really shift up or down. I mean, we could go into backwardation pretty quick if he surprises the market, and that could lead to a pretty sharp drawdown. And we have so many short-dated puts in the S&P. There's 3.3 million S&P-X puts, a little bit over, I think, and a lot of these single stocks have just been getting hammered. But the VIX is it's kind of primed and ready to move, but you could easily see that whole kind of term structure shift lower, right? And that would be a catalyst for stocks to move up.
I think weakness this week on the back of a hawkish Fed will probably provide an opportunity to either buy the S&P in some shape or form for a rally into year end and early January, where people will allocate money back into the markets. And you can either do that via S&P longs or you can do that via VIX put options. I think January VIX put options, given that January VIX is something like 24, I think.
Yeah.
Is that where it is? January? Yeah, I mean, if that goes into the high 20s, let's say, in a bout of weakness this week, you'll be able to buy some pretty nice strike January VIX puts for not a lot of premium. So that's a play that I don't think is a bad one heading into next year.
Yeah, and I kind of echo that sentiment. I mean, in our note this morning, we kind of laid it out that my kind of gut feeling on this thing is that there's so many big put positions that are really getting a lot of juice right now. I mean, if you flip through any of these chart books and look at, excuse me, anything from AMC to Nvidia to AMD, right? A lot of these market leaders, even Apple, right? These stocks are starting to turn south, and obviously the S&P is selling off a little bit today. But and granted, in Apple, we're talking about a huge move, but puts are in control at the moment. So let's just take a couple look at a few of these different gamma curves here to give you an idea of what I'm talking about. And what I'm sort of going to get into is that I think, and tell me what you think about this, that the fact that we have all this put open interest that's going to expire on Friday, we have all these hedges, right, that are tied to those puts, tax loss selling, whatever else it may be, that unless the Fed really, surprises and shocks people, that just as a function of positioning, volatility coming down, I'm not sure exactly what. I have to look at what the S&P's realized over the last 5 days, but the VIX is sort of pricing in certainly larger moves going forward, and that's a lot of energy that could really come off in the market and express itself higher.
Yeah, I agree. I think skew and vol is a little bit pumped now going into this week. I think it overshot a bit last week, to be honest, getting VIX back onto 18 handle. I think now back where it is in the low 20s is about right. I think on the rally, put premium stayed relatively firm, and that makes sense because people kind of rushed into protection first for the Omicron stuff, and now for a more hawkish Fed. And so, yeah, I don't see us completely falling out of bed in this market. I think a retest of those levels at 4,500 is probably about as good as we're going to get if we even go to the downside. But at that point, you'll be retesting that low. You'll probably be doing it with relatively weak momentum, and you'll get a bullish divergence from a technical perspective. And then I think you'll be wise to look for bullish setups, basically.
Yeah, and not only that, I mean, we should make a reference to kind of two things at this point. One, we haven't had a chance to talk about this, but that VIX at 33, just a week or two back. I mean, relative to what was happening in terms of the S&P, people were really positioned for like Armageddon, really, I guess, off of the coronavirus news, and then I think some of the headlines around tapering, shook things up a little bit more. But that level of 33 was something that was larger. There's a higher VIX than the December of 2018 crash. So people were really positioned for just a real bout of volatility. And then, turns out, like you mentioned earlier, COVID's not arguably as dangerous as maybe they thought they were. We're not going to get into that situation, but that seemed to provide some relief that fueled the rally. We kind of just filled the gap, and now we're failing there. But do you have any comments specifically about that VIX 33 from a week ago? I mean, did that seem terribly excessive? Do you think that was purely just COVID?
It did seem like a bit of an overshoot for sure. And what I sometimes notice when those type of VIX moves happen is, for example, January upside calls. I think it was like the 4,800 strike calls on S&P. As the market sold off post non-farms, the market was like 50 points or more lower on the S&P. But those 4,800 calls had gone up in price because the vol had spiked so much. So when you see that happening to options, you know that the vol is overshooting. Basically.
Right.
So that's often quite a good signal for you to know that now's the time to sell the vol because it's done way too much.
We had a poor fella in our Discord chat who was pulling his hair out because he bought some calls that weren't making any money in the spiders, and everyone was trying to sort of explain that concept to him. And I've been in that seat before too. I bought some calls and the market's gone up and vol comes out and you're like, son of a gun, I was going to make way more than this. So it was when the vol is that high, which I don't think often happens in the S&P. I mean, certainly when you're trading Tesla and the like. It can happen a little bit more often. But so let me just pause here. We're getting a couple questions. Someone says, please finish the point on the puts, the big put positions that don't go in the in the money. They move the market up or down. So here's kind of the idea, right? Let's just talk about a stock like Tesla, for example, real quick. We'll just segue here. The biggest gamma position in Tesla is at the 1,000 strike. So we'll use Tesla as an example just to lay out this idea of all these puts expiring. And you can thumb through a bunch of these charts and find, you know, similar structure. But if you see these two curves here, we have orange is put gamma, and in blue is call gamma. And what you can see here is that the orange line is below that of the blue line. So that's telling us that there's more put gamma, right? There's a larger amount of put gamma in Tesla than there is call gamma. If you wanted to have a gamma squeeze like we saw a couple months ago, you'd want to see this blue line breaking below the orange line. That's telling us that calls are kind of driving, right? But in this case, we have a ton of put gamma, and most of the open interest or most of the strike with the biggest gamma itself is at 1,000. So this is a really kind of a loaded area, right? And there's a lot of put gamma, and that's probably helping to suppress the price. And the reason that is because, you know, people are long puts as Tesla's dropping. There's probably a little bit of negative delta hedging flow in Tesla. And then look what happens on 12/17. You have 36% is what we calculate right now. That total gamma position gets wiped out, right? So those forces that are creating volatility, I would argue, right now in AMD and Tesla and even AMC, we put a tweet about that this morning. A big chunk of that flow, of that suppressive, you know, gamma hedging flow is going to be knocked out. And that is why we're sort of alluding to the fact that these stocks can rally, because it's kind of like, you know, the pressure, the selling pressure is going to be alleviated some. And that has nothing to do with the fundamentals that are in these positions, and arguably what the Fed may or may not say. We could get a relief rally just on the perspective or just on the fact that, you know, a lot of these stocks have built substantial put positions that are going to alleviate. So, you know, NVIDIA, another one. NVIDIA is the hottest stock, arguably, this year. I mean, the thing has just been a machine. It's rolling over really hard now. And look, it's all put pressure here, right? And so this is all formed over the last few days. So that is the kind of, hopefully that explains what we're talking about these puts that are going to expire and maybe lead to a rally. And the second component of that, and most of you are probably familiar with the Vanna trade, but, you know, Imran, you want to just kind of give a quick synopsis of what that is, and if the Fed sort of gives the market what they want and they're happy, and VIX and implied vol comes down, you know, you want to outline
sure.
the Vanna trade?
So the Vanna trade is basically the reason why we always go on about this Vanna trade is because Vanna is essentially coming from the idea that dealers have got a structural position in puts versus calls, right? So if we just look at the S&P, for example, right, that's where most of the hedging takes place. So you have clients that are buying puts and they are selling calls in general. So dealers are short puts, downside strikes, and they're long upside strikes. And that's a structural position that is kind of what the duration of that is going to be anywhere between 1 and 2 weeks to 3 months, let's say. And that's quite short dated optionality. So when dealers have got that structural position, not only do they have to delta hedge, they have to delta hedge that. And to delta hedge that, that means selling futures, selling the market, right? Because they're short puts, they're long calls. Those are both long delta positions, and they sell futures against it. Now, those positions are very dynamic. So they initially put their hedges on. Now, if the market moves around, the positions become dynamic, because when you move towards a strike, the Greeks on it get bigger. When you move towards the upside strikes, those Greeks get bigger. And that's what that whole gamma positioning and gamma flip and all the stuff that you guys look at in SpotGamma's website, that's what that's showing you, right? Showing you the street positioning moving around with the spot price movement. But what it's not showing you is how do the delta positions change when volatility changes. So when you've got that structural skew position and vol itself changes, and the easiest way to monitor that is the level of the VIX. When the VIX gets crushed because a load of uncertainty has just been removed from the market, that, for example, what we're going to get after the FOMC this week, right? The market should see the VIX come down. If it's not a complete disaster and the market doesn't sell off 5%, you should see the VIX come down post FOMC. Natural selling of volatility will push that down. And that move down in vol across the whole curve will change the dynamics of that skew position, of that short put long call position that dealers have, and it will change the delta of those positions and force them to buy futures. Right. So that compression of volatility has an impact on the deltas of open option positions that dealers have, and that then makes them have to cover some of those short futures that they've got on. And that's what we call Vanna. It's that change in delta for a change in volatility. Yeah.
Right. And so for those of you who are a little bit new to some of these concepts, there's a beautiful explanation there. I generally like to talk about sort of the people who are a little bit new to this is just look at the VIX, right? Because the VIX is essentially a measurement of the implied volatility of the S&P 500. And so on your chart here, you can see as the VIX spikes, the market goes down, and then as the VIX drops, the market goes up. And the vanna is the hedging flows that are tied to this idea of essentially the VIX dropping, which leads to dealers having to buy back futures that pushes the markets up. I would say that this was a vanna rally that we had over the last several days in the start of December, where the market ripped from like 4,500 up to 4,700, and it kind of stopped on a dime. Two things. Let me just segue real quick. If you want to learn some more about this, we did a video in our YouTube channel here. It's called Options Vanna and How It Moves. We dig into the charts there, and then more importantly, we'll talk a little bit of this at the end. We've launched an educational course. Imran is the instructor. He's more qualified than I am to tell you all exactly what options are and how they move around. And that's at academy.spotgamma.com. We'll talk about that at the end, but we take you all the way through what is an option, call and put, all the way through how to structure trades around vanna, etc. So anyways, back to the markets here. So we had this idea that all these puts are going to expire. There's two interesting things I want to talk about. You mentioned 4,500 on the drawdown. Now, for those of you who are familiar with the big quarterly collar trade that JP Morgan puts on, it's a substantial position. I believe it's around 45,000 contracts. That is in the end of December expiration, right? They don't use the 12/17 expiration. They use the end of December expiration. And so if we do draw down, you mentioned 4,500 as a low, and do you think it's because that there's a lot of gamma that's going to be concentrated right in that 4,500 strike? I believe it's 4,505, somewhere around in that area, and that could play into sort of the year-end lows. I think if we do sell off.
Yeah, I mean, I would argue that if the street is long that area, because that's the call strike of the put spread collar from JP, right? So if the street's long that strike, end of December, 4,500 area, and they're likely short a load of regular December for this Friday on the downside, basically, right? So those two things are kind of at the moment are counteracting each other. So the actual street gamma positioning down towards 4,500, whilst it's flipping a little bit short, it's not crazy short because there's that long coming from the 31st of December offsetting any shorts that they might have in regular December.
Right.
Now, once regular December goes away, suddenly they're going to find themselves actually long quite a bit of volatility, and that should be quite supportive to the market. And that would actually line up really well with, we see a bout of weakness into the end of this week, where we get the market kind of fully pricing in the idea, yes, that the Fed is very hawkish and there's going to be tightening monetary policy coming. We sell off into that area where the street is net kind of short right now. That then all rolls off on Friday, and then the street's actually quite cleansed and quite long because of those options, and then market can bounce from there. Or it doesn't have to bounce that violently if the street is actually long. It can just kind of find its footing and then travel up slowly into the end of the year, and then maybe get a bit more of an influx in January. So that's the kind of price action I could definitely see happening.
Yeah, and I like the idea of the cleanse. It's like let's flush out all these puts. So that structure, if we were to just look at how the market is positioned, I mean, 4,500 is where the low was from last week, and there's a lot of open interest there, as Imran was just mentioning, and so it was funny because vol got so ratcheted, higher. The VIX was so high but the energy just got drained out of the market when it hit that 4,500 level. It just didn't have the push to realize basically a VIX of 33, right? We had a few moves of 1.5%, but the VIX at I believe 30 is priced as something like a 1.8% move. So it's very hard to sustain those types of moves day to day that monetizers allows you to kind of fully monetize implied volatility that high. But what's interesting about today's market is that we measure gamma flipping from positive to negative. So that's our high or low volatility mark at 45.15, which actually proved to be a pretty good support level today. So, the VIX is actually fairly muted, I feel like. I'm sorry, say that again.
You mean 46.15, I guess.
I'm sorry, 46.15. Thank you. 46.15. I drew it on the screen here so everyone can see it. And that's our kind of gamma flip point, but that's a fluid situation, obviously, because obviously so much expires. But if we kind of get under 4,500 and the Fed doesn't kind of appease people, and I think we could visit 4,500, maybe even certainly into Thursday. I think that can happen pretty quick. And then on the upside, there's still a ton of gamma up at 4,700. We note that our intraday metric today shows that it's a lot of long deltas for the most part, trading in S&P options. So, yes, the market is a little bit weak today, but we're not seeing people trying to initiate a bunch of whole new, put positions in the S&P itself, which brings me to kind of another sort of interesting question here. Maybe, Imran, you can answer this, but there's been a lot of talk about the correlation between interest rates and the S&P and stock movement itself. So historically, you had this idea of the 60-40 portfolio, right? And bonds are going to hedge my stock move. And there's some people that are concerned that relationship is changing, right? And that may be incentivizing more people to look to VIX calls or buying volatility as a hedge for their portfolio versus sort of relying on that 60-40 relationship. Do you kind of have any opinion on that?
Okay, so the whole idea was really, people have used bonds to hedge an equity long in a risk parity way because that's what Bridgewater have done for years very successfully, and it's worked. Right now, that works in a world where bond yields are at sensible levels and have room to go down, i.e., bond prices can go up and yields can go down. But when yields got super low, that became less of an obvious trade, that your bonds are actually going to work as the diversifier that you need when risk assets are puking, basically, right? So when yields got super low after Corona in 2020, that risk parity trade didn't look as attractive. Now, yields have kind of popped a little bit now. So there's a little bit of element of, in a real shit show, yes, bonds will probably provide you some protection, but let's be clear, like, some of the biggest risk out there now is actually inflation, right? And so you wonder whether holding bonds in your portfolio in any really big size is that good a trade if we are facing inflation, right? So then you're looking for other diversifiers that can help you. So people look to things like gold, things like crypto, and I know that's very controversial where you think crypto can actually hedge anything, right? Things like crypto, things like gold, things like volatility, like you say, are things that can provide you some of that diversification. A really good source to look at about this topic is Chris Cole. He talks about his dragon portfolio.
Yeah.
I don't know if you've seen that, right? And he's back tested for 100 years of history and found that instead of a 60-40, you're better off having like basically 20% split across 5 different things: equities, gold, bonds, what was the other ones? Volatility and trending commodities, basically. Right? And by doing it that way, the number of different types of regimes that you cover and this is saying, if I had to stick on an asset allocation and run it for 100 years and I wasn't allowed to change it, what asset allocation would I pick?
Right.
And he's landed on that. And the idea being that, certain regimes like the stagflationary regimes of the 70s or whatever, a 60-40 portfolio is going to kill you, right? Because the bonds are just going to get destroyed.
Right.
Whereas if you had like trending commodities and gold in that era, that really helped your portfolio out, basically, right? So yeah, definitely, I've got a lot of time for that sort of analysis and the idea that a 60-40 portfolio just doesn't cut it anymore.
Yeah, and I think, there was a few moments during the COVID crash where I think particularly that people felt like there was a real dislocation there with bonds and equities kind of moving in sync, and that probably frightened some people. So the Dragon portfolio paper is really interesting. It's on Artemis.com, and then some of his older works are really interesting. I think there's one about what is water, I believe it's called. I forget the name of it, but it's he's a great philosopher as well as a practitioner, I should say. So let's take some questions. I think we kind of, for the most part, covered the topics, all except for crypto. And so, I don't know how much people are on this channel looking for some crypto analysis, but that space really quite well. And what I will just personally say, and this is the only thing I have to offer, is that I think crypto is like the leading risk on, risk off signal. When people are feeling good, that money flows into crypto, and I think it's the first place that money comes out of. If you get margin calls and the like, or you need to sort of free up some cash, I think crypto is kind of the first place to sort of try to draw some of those funds, right? But what do you think about the crypto space here? We're looking at Bitcoin. Tell
Yeah,
us what you see.
I think you're right about that. It's a good sentiment barometer to see how crypto's doing. Certainly for retail psychology and things like that. I mean, coming into December, the whole crypto market was super bulled up and ready for, and they have been pretty much from November, right? They've been bulled up, ready for a year-end rally. It looked like it was on. We eked out a new high in the high 60s, and we were targeting something like 80 to 100K on Bitcoin, right? The whole market kind of got its head ahead. And there's that seasonality in crypto where you often get that year-end rally. People are excited. Okay, so they got completely wrong-footed. There was a very key level around 53K that broke over that weekend, and we had this horrible sell-off of 20% in a 24-hour period that liquidated about 25% of all of the futures open interest in the market. Okay,
Wow.
so pretty big shit show over not last weekend but the weekend before. Now market kind of is now figuring out where it wants to go. Price action is pretty bad. Rallies are getting sold. For technicians, I look at Elliott Wave and things like that, and that break of 53K in Bitcoin invalidated the five-way move that I was looking for up to 80K into year end. So that means we're probably drawing out a slightly larger degree correction, which targets somewhere between 30 and 40K on the downside. And that also ties up with the idea that risk sentiment has turned south and we are seeing a more hawkish Fed, and the idea of less liquidity, which I think will impact crypto markets, right? So I think that's where I'm positioned. I've kind of hedged out a lot of my exposure in crypto. I've been long for a while, but I'm pretty neutral here. I'm slightly long Ethereum, short Bitcoin as a spread right now. I think Ethereum's still got some signs of life compared to
Yep.
Bitcoin, and it's got some more upside. But that's kind of, I'm using various option structures and things to hedge myself, a bit of futures, a bit of options. I monitor that volatility market pretty closely as well.
Yeah. And what's an interesting thing here too is as a tying it back to equities is there are a lot of stocks now that are tied to the crypto market in ways that previous to this year weren't. I mean, there's such euphoria around the meme stocks, obviously, and then crypto that it became really fashionable as a CEO, right, to say, well, we're a crypto. We got a crypto business now, right? And one of them is Robinhood, obviously. And we put this on Twitter yesterday that it's something, I think it's like, I'm going to misquote myself, but it's a material amount of their revenue came specifically from Dogecoin commissions. So, a lot of almost the bulk of their revenue comes from payment for order flow, which, if the options market's kind of, you wonder about how well those customers are doing, right? The average retail guy on Robinhood. And then, certainly if the crypto market keeps crashing, that's probably going to take out a lot of the volume for them there. So, the crypto space now has some real implications on how some of these, major listed stocks could do. Obviously you have the Maras and Riots of the world, but, Robinhood is kind of the one that really comes to mind here. I mean, that stock is, as you can see on the screen, is $19 now, well below the IPO price. This is a big ARK holding, and ARK is not doing all too well. Actually looks like taking out the low of a few days ago.
Yeah, no, I think that's a good point, right? And you've got obviously people holding crypto on their balance sheet, likes of Square, likes of MicroStrategy,
Right.
things like that, right? So yeah, there's a lot of names now that are pretty heavily in the space and impacted by it. So if we do get a further 20-30% downside, which is certainly not out of the question, then yeah, that's gonna take a lot of stocks down with it. Now I do think ultimately though, crypto does bounce from there. I don't think it just goes to zero directly now. I just think it got a bit ahead of itself. Everyone was in the same side of the boat looking for the year-end rally, and the market loves to find the path of pain, and that was what the path of pain was. But there is a ton of institutional money ready to come in next year,
Yeah.
most likely, and that should provide some support and some traction. So I think it'll be actually quite healthy to see a flush out somewhere
Yeah.
towards 30K again, for us to then build on in the first half of next year.
And I kind of liken it to the internet bubble a little bit, where you knew internet was a future, right? Crypto and decentralized finance, there's so much promising, interesting things happening there. But just like in the internet bubble, there was a lot of guys like, the euphoria hit really early, it washes out, and the strongest guys are left standing. So let's take a couple questions here. The first one here is someone asked, how can I calculate the implied move on the NASDAQ? So I was going to suggest you just pull up the VXN, which is the NASDAQ VIX, and then divide that by 16. Or you could take the at-the-money volatility, say about 30 days out, of expiration about 30 days out, and do the same thing, the rule of 16. Do you have a better suggestion there?
No, same thing. But I mean, I wouldn't take the Vixen and divide it by 16 because there's a bit of premium on the Vixen. I'd take the at the money vol. That's a better reflection.
Okay. So if you look in your options montage and maybe look at the January options or choose even something a little bit shorter, and take the at the money options and the NDX or even the Qs and look at the implied volatility and just divide the implied volatility by 16. This is called the rule of 16, and that will tell you what the expected one-day move is for the NASDAQ or the Qs, depending on which one you want to look at. We had a couple questions on some single stocks, so let's flip over there. I think the first one is Tesla. We covered that a little bit before. Most of the game is at 1,000. I think, again, we showed earlier, it's a lot of puts. And so with this expiration, we think that's probably going to give a lift, assuming that Powell doesn't really just upset people. We think that we'll get a short-term bounce off of this expiration game because all those puts are about to expire. But let's take a look at AMD here, another one of the top stocks some people are asking about. Yeah, so, this is such a similar thing. Just like NVIDIA, Tesla, etc., again, the put gamma is larger than the call gamma. So what this is telling us is, like, again, if you were looking for a gamma squeeze, you would want to see this blue line really extend. I'll find a stock that maybe is positioned like that at the moment. But the fact that this orange line is below tells us that the put gamma is more in control. There's more put gamma than calls at the moment. AMD, like some of these other stocks, has a lot expiring on Friday. So, the idea here is that the relief here, the release, or the cleansing, as Imran likes to call it, could lead to just a kind of a short cover rally, right? It doesn't necessarily have implications for anything farther than, a week or two. But this idea of a short cover rally is what I'm sort of warm to at the moment, and I think Imran is as well. Let's see here if we scroll through. What else do we have here? The website that we mentioned was Artemis. So if you just Google Artemis Capital or Chris Cole, Cole, you can find his papers.
If you search Dragon Portfolio Chris Cole, then it'll probably send you to the paper, basically, right?
Yeah, that's exactly right. Let's see here.
I also think sentiment's really beaten up though as well, right?
Yeah.
After the Omicron and now the hawkish pivot from the Fed, sentiment's pretty poor out there, right? So I think there is a bit of a risk of a squeeze into early Jan. We just need to get this expiry out the way.
Yeah, I mean, we're just looking at the IWM here. I mean, that, it's had a pretty substantial rally off that initial lows of the COVID crash. But as far as this last year, it really is kind of been left for dead. It seems like here, really affected by the small cap sort of destruction that's taking place over the last several days. So I'm kind of on your side there. That again, the edge you have to give is to just some kind of a relief rally, kind of short cover rally here. Kirk wants to bring up BABA, which is like, man, I don't know what to tell you about that, Kirk. The Chinese ADR. I mean, do you have any comments on all that?
Well, I mean, China as a whole seems to be bottoming out a bit here, right? We're starting to see signs of stimulus coming out of China. They cut the RRR rate. They, price action after the Evergrande default was pretty stable. So we get the feeling that China might start an easing cycle now, whilst the rest of the world is a tightening cycle. So at the margin, given the underperformance of Chinese equities versus everything else, there's probably some outperformance to be had in China. Now, in terms of the actual ADRs of those type of companies like Baba that were US listed ADRs for Chinese companies, I don't know. There's quite a lot of regulatory hurdle there and issues like the K-Web has been destroyed.
That's what I was trying to find.
They're all delisting out of the US because of China basically saying you can't list in the US anymore. So I don't know if there's some factors there that are going to prevent like the K-Web from recovering, but mainland Chinese equities are looking more healthy, showing signs of life. We're also seeing like iron ore prices bounce as well in China. So I do think there's potential catch-up trade in Q1 for Chinese equities. But just not sure about specific names like Baba.
Right. I mean, we're looking at the K-Web that's down to 2018 levels. Basically, it's just been pretty remarkable how fast that's It's driven down, and if you look too, here's a great example of a stock that just has a ton of puts. I mean, Baba, the put structure in this thing is huge. So, not a lot of gammas expiring here. I think until that the Chinese delisting issues are cleaned up, that it's just kind of a gamble as to what may or may not happen there. So Intel's actually got kind of an interesting position here. So 50% of the gamma is going to expire on Friday, but the fact here you can see that the call line is breaking above. So if we kind of break out over 50, this is the stuff that you can get a little bit of a run from calls happening, kind of breaking up over 52 here. So this structure will change obviously a little bit over the next couple of days, but the fact that most of the calls are at the 50 strike, again, we'll see what happens on Friday with how all this changes, but it's a pretty interesting, long idea here. I think it's a pretty stable name. It's probably not as susceptible to a rate change like some of the other more, speculative names in the space. So that's kind of an interesting long idea, I think, there. Let's check Apple. We're getting another question about Apple. So, okay, here's a great, now Apple's a funny stock because my opinion is, and Imran, feel free to weigh in and disagree with this, that a lot of people own Apple stock. That's not the part to disagree with me on. But I think there's a lot of overriding in Apple. I think a lot of people have owned it for a long time. It's systemically sort of just, write calls against it, bring in some more income against essentially the de facto U.S. stock. And so even though here you can see there's a lot more call gamma breaking above, which can be a bullish signal, there was a kind of a gamma squeeze recently with really high call volumes. But I think the traditional position in Apple that we see, and this can be backed by the fact that there's huge options volumes every single day, and there's a giant options position in Apple. I think a lot of that's call overriding, which makes the gamma structure similar to the S&P in terms of where dealers are long or short gamma.
But then this structure has got negative though. So are you saying that this Apple gamma that's showing as negative on the calls is not actually negative then?
Yeah, and that's what I would say is that we have one default model here in the equity hub. And so, when you look at this, you say this is a lot of long gamma, this is a lot of negative gamma. This is telling us there's a lot of calls positioned here. What I'm trying to say is that even though the chart suggests gamma squeeze possibility here, the fact of kind of the matter is that I think a lot of these calls are traders who sell short for income versus market makers who are long and probably doing some callers and things like that, wherein they sell calls to buy puts. So, take this chart, and Apple's a pretty unique situation. I think maybe some of the banks will be similar, or, the classic, dividend stocks like Coke and some things like that. But, there's always a huge position in Apple. But if this was a Tesla chart, I would say, for example, yeah, this thing could really gamma squeeze, right? But, Apple would take that with kind of a grain of salt.
There's almost like an adjustment you need to put into that call gamma line to reflect that this stock is such a big blue chip stock now that actually there's probably a bunch of call overwriting, which the model isn't taking, because the model's just assuming calls are now short in single stock, right? Whereas you can't use the bulk default assumption for all single names, is what you're saying.
Yeah, that's exactly right. So we're actually working on a way of looking at the volatility surface as a way to start to sort of handicap the way that some of these positions maybe are posted. But if you look at Coca-Cola, which I mentioned, it's a similar thing, right? Like there's not a game. Actually, there may be a game of squeeze now setting up in Coca-Cola as the stock's been kind of going pretty crazy. But I think it's a similar thing in many of these kind of dividend stocks. So that's just something to kind of be aware of. So let's take just one or two more questions here because we're coming up on an hour. So someone was asking about Square, PayPal, and MasterCard. PayPal is just an interesting one as Square's as well. This stock, again, you can see here, it's so much put open interest. This stock dropped as they were talking about possibly purchasing, I think it was, what's the picture company?
Oh, yeah.
Someone's going to back me up here. I'm having an old man moment.
Pinterest.
Thank you. Pinterest. And that set off just this cascade in prices here. It is kind of a crypto stock, but look, they got a pretty good, fundamental business of taking payments on the web, which clearly is not going away. And I'm not here to posit on the fundamentals, but I will say, that again, so much of the gamma, 25%, which is a little less than some of these other positions, expires on Friday. Again, if you want to see the put gamma here, which I feel more comfortable saying people are long calls here and long puts. And so, this position should change. And if I could see the call gamma kind of bleed over the put gamma, then maybe we could get a recovery here, or a little more of a rally. Do you got anything you want to add to this PayPal position here?
No, I'm not really. I don't really look at these singles regularly enough to weigh in on this.
Someone said PayPal's buying Kodak. No, no, that was a couple years ago. Troy, yeah, Pinterest. Thank you, Brandon. And then, so Paul's commenting. He mentioned that there was a very big 46.50, 47.50 long call spread for December 23rd, and there was over 10,000 was bought at 9.51. So those are some short dated positions. It's a pretty large long gamma position. How might a position like that, do you think, I'm kind of putting you on the spot here, affect the market in the short term?
What strikes is it?
The 46.50, 47.50. So those are just sort of at the money, just slightly maybe out of the money. Obviously, if the Fed does anything other than really make people upset, vol should come down, and that could start a rally. And what you're doing is basically adding long deltas onto the dealer's hedging requirements, right? So that could, 10K is a decent size, and short day to get out a little bit of fuel to the market.
At the moment, it's buying some gamma off the street. But if we do pop our head above 4,700 by early next week, then the street's actually going to be long on that 47.50 strike, basically.
Yeah.
Right? So it's a very dynamic Greek's position because it's a 1 week call spread, 100 points apart, right? So the gamma impact it has on dealers' position is quite spot sensitive. Mm-hmm. Down here, we're parked below that front strike. It is a net gamma buy from whoever bought it. Therefore, it's a gamma sell from a dealer's perspective. But like we say, back at 4,700 or above, it flips back the other way, basically, right?
Yeah.
And so it's quite a good structure. I mean, I don't know how much premium that person's receiving though to sell the 47.50s. They can't be worth a lot, right?
Probably not. I mean, you kind of raise a good point. I mean, I guess why bother capping that? But I think that 47 area, the 4,700 area is an interesting area to sort of cap the position off at. We call that our call wall level. So that's the area that has the most current call open interest. So we'll show, why we say that. But here you see where the most gamma is. Let me actually flip my screen here. So here's where the most gamma is in the S&P 500 at 4,700. And then at 4,750 is this idea of the call wall where there's a lot of calls already positioned there. We know that a lot of people are selling calls over the last week on the rally into 4,700. So, the dealers are probably long a fair amount of gamma up in that space, and like you said, I mean, how much premium are you going to bring in for that? It's a fair question to ask.
I would almost. It depends, right? Like it might be worth it. I don't know exactly how much premium that thing's worth, but if it's not worth a lot, the better way to kind of trade that a bit more opportunistically might be to buy the 46.50 call here. And if we get a 50-point rally, that's when you sell the 47.50 call after, once it's got some juice in it. It doesn't really feel like it's got a lot of juice in it down here, I imagine.
I also wonder, is that an opening trade? Because that seems actually like maybe something that, if it was a closing trade, they probably did all right on it. And it would be good timing to close that trade out. It was closed kind of very near the lows. Looks like it was a positive delta trade. So
I think it's an opening trade. Yeah. It's the sort of trade that if you're bullish for next week and you think we've had our expiry dip and you want to play it, it's quite a sensible way to get leverage to that rally, basically.
Yeah.
The call spread probably isn't that expensive relative to the 100 points that you can make, right?
Yeah. Very, very good points, Imran. So, as again, someone's asking what we think about tomorrow. My personal opinion is, why trade before the Fed, right? Let the market decide how it wants to react. And I think we're going to get a pretty good directional move on the order of 3 to 5% between kind of now and the end of the year. So let the market, show its hand, and look to structure some trades around sort of either basically play vanna, right? Either vol's going to go higher and you want to play it one certain way, or the volatility term structure decompresses, and that'll fuel a pretty good rally. So that's kind of what we're looking at over the next couple of days. So Imran, I know you're in London. It's super late there, so we should probably end it there as it gets a little bit closer to the end of the market. Now, I just wanted to talk quickly about the SpotGamma Academy. You are the instructor for the SpotGamma Academy. We have 3 courses set up. This is brand new. It launched on Monday. You can take a bundle, or you can sort of choose to only take one of the 3 courses. But you walk everyone through the basics of calls and puts to how to structure trades around these these vanna type Greeks or second order Greeks. You got anything you want to say about the courses? Anything you want to offer people?
Just that it's called the Hedge. We've called it the Hedge. It's a 3-part course, as Brent said. We've basically got 3 levels of kind of complexity, if you want to call it. Junior trader, perfect for complete beginners who really don't know anything about options. But then, getting into the meat of the Greeks and how to think about how an options price moves around and the different impacts of the different Greeks. To learn about that, that's our middle senior trader, and then portfolio manager really brings in a lot of stuff from my boot camps and things like that I run at Options Insight. Gives you the ability to understand term structure and skew, second order Greeks like vanna and charm, also combined option strategies like call spreads, call ratios, risk reversals, butterflies, condors, those type of things, and understand why you would do those trades as opposed to just straight calls and puts, and what they give you in terms of improving your risk reward and allowing you to tailor your Greeks to your specific views around volatility and the market, basically. And that's what options really allow you to do. And hopefully we've done a good job there of really breaking it down and fixing it.
Well, this nice guy Niral, I apologize if I mispronounced your name there, said he finished the junior trader already. So it's very good. So however much you paid him to show up and make that comment, it was well worth it. But I took the courses too. I like it. I think the one thing I want to say is there's this axiom of teach a man or a woman to fish, right? And that's really what we're trying to do. There's no this is textbook stuff here. And we're trying to be, really explicit about how to take advantage of the flows that we see every day in the market, right? And you don't need to use SpotGamma stuff to, to be successful here. But, we hope that you all will enjoy that course, and I think everyone can get a lot from it. So, anyways, we're gonna leave it there. It is very late there in London, so thank you, Imran, for hanging out with us and talking about the flows. We didn't have any tech issues today, thankfully, so that's always a plus. And if y'all have any questions, put them in the comment section below. You can send us an email at info@spotgamma.com. And Imran, why don't you tell them about how to get a hold of you?
Well, yeah, one last thing I'll say on the Hedge is that once you do sign up for the Hedge, you get access to the Hedge call, which is basically a half an hour call that I'm going to run every Tuesday starting in January. So that will allow you to ask any questions that you may have on the material that we cover in the Hedge, and you'll get access to me for half an hour every week on a Tuesday. Which will hopefully help you if you do come across any hurdles there, any roadblocks.
And in case you can't get enough of this face, there's a lot of this face here.
There's too much of that face. I mean, and then if you want to touch base with me on Twitter, I'm options_insight on Twitter, and on my website, options-insight.com. You can book a consultation to say hello to me or the sales team and talk about our products and stuff on there as well.
Right. Cool. All right. So thanks again, everybody. Good luck trading tomorrow, and it should be exciting.
Cheers, guys.
All right, buddy. Take it easy.
Bye.